In this week's video, we'll review the latest charts to help us answer the question, will next week's Fed statement spark a sharp reversal or painful plunge in stocks? This is a daily chart of the S&P 500 index as of the close on Friday, December 14th, 2018. There's an easy way to sum up recent trading activity. We have an ugly tape, which will make it very, very easy to execute if things do not improve. We've got a ton to cover this week, so we will be moving extremely rapidly. We outlined our basic approach using this chart on November 2nd. We haven't strayed from that approach, and we continue to implement as described. Between the close on November 2nd and Thursday's close of this week, every single S&P 500 close was above the orange line. During Friday's trading session, this line was under assault, and if and when we move in this direction, we will implement as described in the past. Near the end of last week's video, we referenced this chart and said, how long is this concerning look relevant? The answer was, as long as it still looks concerning. And despite the 17-point rise in the S&P 500 between Monday and Thursday of this week, price action was still not particularly impressive. And obviously during the day on Friday, it has not been impressive either. Thus far, everything we've seen says stick to the plan. It's an updated look at the Treasury market. This time we're looking at long-term Treasury bonds in isolation. When the S&P 500 peaked here, bonds above slope up. When things got really, really ugly in the S&P 500 in September, this was the look of the long-term bond chart. Similar situation here, peaking process in 2007. And this is the end of 2007, where the market took another 14% leg down. These are bond charts anticipating an ugly recession in a bear market. Latest economic data from Urban, hot off the presses, Friday, December 14th. Present day retail sales really doesn't look anything like the lead into the dot-com recession. It really doesn't look anything like the lead into the financial crisis. Does the present day bond market align with this data? If the answer is yes, we would expect the present day market not to look like this or this. And that is the case. The weekly chart of TLT on December 13th, making a lower high. Slope of the 22-week moving average is down. This really doesn't look anything like this, and this really doesn't look anything like this. As we noted last week, that really doesn't tell us anything about what's going to happen in the short term. These charts simply speak to longer-term probabilities. Remember, there were plenty of reasons not to buy bonds near the peaks in 2000 and 2007. Thus, why did investors buy bonds? In short, they were confident the economy was headed for a recession, and they were front-running or anticipating what they believed to be future Fed rate cuts. That worked really, really well for them in the dot-com bear market, and it worked really, really well for them in the financial crisis bear market, which leads us to a reasonable hypothesis. Why does the present day chart not look like this or this? One reasonable hypothesis is that the present day bond market is not anticipating any of this. Obviously, that's subject to change, but this is the look of the weekly chart on December 13th. Thus, heading into Friday's session of this week and heading into next week with the important Fed meeting, do we have A, reasons to be concerned, and B, has there been any rational and factual basis to try to remain patient in here? Since we've covered most of these topics, we are going to be moving at breakneck speed. I think it's fair to say, if you pause your video player, that this case here looks very, very similar to this case here. This is the 2011 low that we covered on short takes back on November 12th. And we know really good things happened after this point here. And in that short takes post, we talked about the possibility of retesting this low. This is the S&P 500's chart, Monday of this week. Will this hold? That's to be determined, but this definitely looks similar to past lows, which only speaks to odds. And we already know from past videos, this point here in 2018 also had similarities to the Brexit low in June of 2016, low in February 2016, October 2011, and May of 2009. Factual reasons to try to remain patient and open-minded. In order to move quickly, you can find these tweets on these Twitter feeds. December 13th, 2018, December 11th, 2018. Tech sentiment is as bearish, unbelievably, as it was near the lows after the financial crisis. That means sentiment is as pessimistic today as it was after the S&P 500 dropped over 50%, and Lehman Brothers failed, and the entire financial system was brought to its knees. Another reason to try to be patient. Returns in tech stocks averaged 29% from these points over the next year in the past. These sentiment readings here are so pessimistic, they're lower than 98% of the daily readings dating back to the year 2000. And that includes the dot-com bust bear market, where stocks fell over 50%, and the financial crisis bear market, where stocks fell over 50%. We've talked about similarities to the retest of the 2016 low. American Association of Individual Investors survey results, very, very similar to the readings near this low here in 2016. Simply a reason to be patient. It does not predict the future. December 13th, 2018, U.S.-based stock funds post $46 billion in outflows, the largest run for the exits on record dating back to 1992. As we've shown in the past, these type of fund flows can be a strong contrary indicator. And yes, we have ugly and concerning technicals and asset class behavior in the present day. You could have made the same argument near many, many lows and during the bottoming process numerous times in history, including at this point in 2011. A fair rebuttal might be, you cannot compare the lows in 2011 and 2016 to the present day because central banks were accommodative in those periods, which is not the case today. Many have forgotten that the Fed played a very, very big role in this plunge here leading up to the February 2016 lows. The Fed talked about raising rates 4 times in 2016, and the market didn't like it. This is not a friendly or accommodative stance from the Fed. And the Fed also played a huge role in helping form this low in 2016 by backing off that hawkish stance. This is press conference risk. As noted on Twitter, We also have PE ratios in the present day that have fallen back to levels last seen here near the 2016 low. Again, tying the present day back to this bottoming process. And I'm sure many of you remember that it felt terrible intraday here on October 4th, 2011 when we took out this low here. Did central banks play a role in this plunge and the subsequent reversal? The answer is absolutely positively yes. The ECB and the European Union were very, very hesitant to talk about bailing out banks in here. They eventually cracked and launched a program in December. However, they started talking about changing their stance about banks, press conference risk. Here, the market begins to realize that this is going to happen. Central banks played a big role in this low. And the same concepts apply in the present day as we've covered in the past. We have a big Fed meeting coming up next week. It is possible that it could turn the market tide. This is an extremely important point about the model and how to use data. And we could cite numerous examples. This is one anecdotal example. 2006, the market makes its lowest low on June 14th. The weakest technical profile, matching the weakest profiles seen in here, occurs 58 days after the correction ends. Moral of the story, it's not unusual to have very weak technicals and ugly asset class behavior after a low is made. In this case, the gain between this point here in August and the low was 3.89%. We have what appears to be an attempt at making a bottom. And we have a period of indecisiveness, which looks very, very similar to the present day. Despite the terrible technical profile here, patience paid off in this case in terms of seeing if a retest would pass or if these lows would hold. Notice, after the low, we have numerous red days, tons of selling pressure, and whipsaw after whipsaw. All of this is similar to the present day. It doesn't mean the present day is going to hold. It just tells us it is prudent to see what happens. How prudent? Well, in this case, if you were patient in here and didn't overreact, the gain between point A and point B was 19.48%. Any other reasons to continue to implement the incremental strategy that we laid out weeks ago? We believe the answer is yes. We still have similarities from a fractal perspective to late 1994, early 1995. We've covered the similarities in the past. We've covered the ugly profile in December of 1994. And we've covered the gain that occurred after point A. Other similarities: 1994, rate hike after rate hike after rate hike after rate hike. Similar to the rearview mirror in the present day. Also similar to the present day. While all of these rate hikes were taking place, the stock and bond markets did not perform well. What helped turn the tide? The Fed raised rates only one time in 1995. Once the market sensed the Fed was taking a break, it took off like a rocket. We have a Fed meeting literally days away in 2018. And as this December 13th, 2018 headline says, after 2 years, the Fed may signal the end to its one rate hike per quarter pace, which is very, very similar to the message that was delivered in here. Our incremental plan respects the press conference risk associated with next week's meeting statement and press conference. It also respects that we could get a move like this. Okay, the Fed takes a break, good things happened. You might say, but in 2018, we have tariffs and an ongoing trade war with one of the most significant economic players of our day. We had something very, very similar in 1994. The Clinton administration plans to impose record tariffs on 13 luxury cars. The White House says the Japanese government and Japanese automakers have collaborated to all but close Japan's market to foreign competition. This trade war had been going on for 20 months, looking backwards from June 28th, 1995. You may be saying, but in 2018, we have a special prosecutor investigating the President of the United States. Well, unbelievably, we can check that box too. In January of 1994, Attorney General Janet Reno appointed an independent counsel to investigate Whitewater. Okay, but in 2018, the yield curve is about to invert. That is true. December 4th, 2018, about to invert. But as we've covered in the past, you could have said the same thing in 1994. The yield curve is about to invert. What happened from this point here? As we know, really, really good things happened in the stock market. The yield curve didn't invert. It may in the present day, but it has not inverted yet, which was the case in 1994. We also know from past videos, even if the yield curve does invert, it could take a long, long time for the S&P 500 to peak. It could take a long, long time for the S&P 500 to peak. Again, going back, reasons to be patient this week. Between last Friday's close and Thursday's close, the yield curve improved. The reading on December 4th was 0.11. It moved up to 0.16 on December 13th. Our plan, of course, takes into account the fact that we know really, really bad things can happen from profiles similar to the present day, and really, really good things can happen. All of that is to be determined. Let's talk a little bit more about press conference risk and game theory from both a bullish and bearish perspective. If you've been watching the Fed for years, you know the odds are extremely high that they are going to try to give the market something favorable next week. And as 1994 shows, it's possible the market reaction will be not only favorable, but very favorable. However, it's extremely important to recognize that this is a major wild card. And it's also possible that the Fed has done irreparable harm. They may not be able to recover from the October 3rd statement where Powell said, we're a long way from neutral. We have to respect that central banks and government officials tried to stem the tide numerous times during the financial crisis and were unsuccessful. It's quite possible that no matter how hard the Fed tries next week, that the reaction will be negative, which is why we are sticking to our plan in a firm and no questions asked manner. From a game theory perspective, we know that no Fed chairman wants to be labeled as responsible for a recession and a bear market. And the leaders of China in the United States also politically do not want to be responsible for recessions and bear markets. However, no matter how hard they try, it's possible that the die has been cast and the trade war has done irreparable harm. The Fed's missteps and the trade war may bring a recession and a bear market. But based on history and common sense relative to the outcomes they want and the facts that we have in hand, this type of scenario is still possible. And we should note, possible is quite a bit different from certain or probable. We already have quite a bit of good news on the trade front, and the market has not responded. The S&P 500 stayed above this orange line for 41 days on a closing basis. That may be about to change. This is being recorded during the trading session on Friday. It's no problem. We have a game plan for that, and we will execute. Quickly, what happens if we get a doji candlestick at the end of the year? Does it automatically mean this look will morph into this look? As these candlesticks and arrows show, the answer is no. Sometimes harder markets are followed by easier markets. 1994, doji, good things happened. Another similarity to the present day. As noted on Twitter, there was also an incredible amount of selling pressure at the open on Friday. And we noted last week that there were legitimate concerns about asset class behavior, legitimate bearish concerns. And yet, between Monday and Friday's session, VGT was beating XLV as of 11:05 a.m. on Friday, December 14th, by 2.17%, and the low was made 3 weeks ago. Again, not a reason to abandon our plan, but a reasonable reason to try to be patient and to execute in a cool, calm, and collected manner. This is the look we want to avoid. This is the look we want to avoid. And there's no question, as of December 14th, 2018, the present day look here is more concerning, quite a bit more concerning than what we had in October. And this look here, this is a tight cluster turning down. It's concerning. And this is a reason to execute in a strict manner. If levels are taken out, they're taken out. And we will not hesitate to take action. We mentioned earlier that this could be a positive. This sprint for the exits, never seen before, could also be a negative. This could align with the fool me once, fool me twice, you're not going to fool me 3 times hypothesis that we've covered in the past. People could run for the exits at breakneck speed, and thus we will execute as outlined. Because we know the present day could morph into something like this or this, and we also know the present day could morph into something like this sometime in the coming days or weeks. It's important that we remember our objective is longer term. As we've noted in the past, was it too late in December of 2007, and the present day looks similar to this, to take defensive action? The answer is absolutely positively no. And if the technicals can improve, and they've shown us next to nothing so far, but if they can improve, it's still possible that this could morph into something like this. We'll continue to take it day by day. The incremental process takes into account that the market may never right itself from a trend perspective. And it also takes into account, despite how many levels are taken out, the trend can reverse itself in a bullish manner at any time. Have there been reasons to be patient over the past few weeks? We believe the answer is absolutely positively yes. We've just covered all of these reasons. Why is it possible that all of this is relevant? Because people and psychology do not change. The question for us right now is, are we dealing with psychology in this scenario, or are we dealing with psychology in a scenario like this? There's no perfect way to answer that question or to handle what comes next. But we do have a prudent and rational way to approach difficult markets. And it's extremely important to make this distinction in closing. The statement that it's prudent to be patient and see how things play out is radically different from saying we're bullish. We're simply respecting that from ugly chart patterns, history says a wide range of outcomes are possible. And for clients that haven't been following along closely, this December 6th short takes post is worth reviewing relative to how we choose the when to take action levels. We do not choose the most obvious levels, such as 2603, and we do that for prudent and rational reasons as well. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.